Welcome in, everybody, to another deep dive with us. Today, we're going through Warren Buffett's 2018 letter to Berkshire Hathaway shareholders. This letter is always a treasure trove of insights into his investment philosophy and just the way he looks at markets.
Yeah, it's amazing how he, blends in Berkshire's performance with broader economic commentary.
Right.
It's almost like you know,
Yeah.
a,
Many.
a snapshot of the economy through his lens, right?
Yeah, through the Oracle of Omaha's lens, right?
Exactly. And so he kicks it off talking about Berkshire Hathaway's $4 billion GAAP profit in 2018.
Right.
Sounds impressive, right?
Yeah, 4 billion.
4 billion, but then he kind of drops a but in there that's like,
There's a little asterisk.
yeah, there's an asterisk.
Yeah.
There's more to the story.
Yeah, because a new GAAP rule forced companies to include, unrealized gains and losses from investments in their earnings.
Right.
And so this created some wild swings in Berkshire's quarterly earnings, even though their core operations were doing well. And he even calls these swings wild and capricious.
Right.
Why do you think he's so against this accounting practice?
I think Buffett really believes in transparency and consistency.
Yeah.
He wants you to focus on operating earnings
Right.
as a true measure of performance, not be misled by the fluctuations of the stock market.
Right.
Those unrealized gains or losses.
Right. So don't get caught up in the short-term noise. Look at the actual fundamentals.
Exactly.
And speaking of fundamentals, Berkshire saw a 41% increase in operating earnings compared to 2016.
Yeah, that's impressive.
That's a sign that the businesses are actually doing well.
Yeah, the businesses are churning.
Right, but then there's another shift happening. He's moving away from using book value as a key performance metric.
Yeah.
What's behind that?
Well, I think there are three reasons, really. First, Berkshire's focus has shifted from holding marketable stocks to owning and operating businesses.
Right.
Okay. And second, accounting rules often undervalue these operating companies on the balance sheet. Their true worth isn't accurately reflected in the book value. And finally, Berkshire's buyback strategy, which we'll discuss later,
Right.
increases intrinsic value per share, but actually lowers the book value.
So how should we be evaluating Berkshire's performance going forward if book value is becoming less relevant?
I think you need to focus on the long-term intrinsic value of the businesses,
Yeah.
not just the numbers on a balance sheet.
So the actual businesses themselves.
The economic engine.
And to help us kind of visualize this vast empire, he uses the imagery of 5 groves to represent their different holdings.
I love this analogy.
It's a great analogy.
It's like walking through a forest of, wealth.
Yeah.
Great.
So he talks about non-insurance businesses, publicly traded equities, companies with shared control cash and cash equivalents, and of course the insurance operations.
Of course.
It's kind of like he's walking you through, a diverse, portfolio of wealth.
Yeah. And the non-insurance businesses, the companies that Berkshire fully or majority owns are like the towering redwoods of this forest.
Sure. Right. And these are the ones that grab your attention, right? We're talking about giants like BNSF, the railway,
Yeah.
Berkshire Hathaway Energy.
It's huge.
And those two alone brought in close to $10 billion in pre-tax earnings in 2018.
Just those two.
And then there's another 10 subsidiaries that collectively generated significant earnings.
Right.
I mean, it's just mind-boggling how much money these businesses
That's
make.
true.
Yeah, he seems incredibly proud of them. What do you think makes these businesses stand out in terms of their earnings power?
Well, I think he highlights their consistent profitability and their ability to generate strong cash flow.
Right.
He focuses on pre-tax earnings
Right.
to emphasize the true economic performance of these businesses
Right.
before the impact of tax policies.
Before Uncle Sam gets his cut.
Exactly.
Huh.
Remember that 2018 corporate tax cut?
Right.
That significantly boosted their after-tax earnings,
Right.
making those businesses and their stock holdings even more valuable.
And speaking of valuing businesses, he kind of goes on this little tangent where he dismisses this metric that's popular on Wall Street, adjusted EBITDA,
Right.
which is basically earnings before all the bad stuff.
Right.
Why do you think he takes issue with that?
It's funny. He uses this analogy, and it's fantastic.
Yeah.
He says, if you call a dog's tail a leg, how many legs does it have?
Right.
4. Of course, calling a tail a leg doesn't make it one.
Right.
Right? So he believes in looking at the true economic costs,
Right.
not manipulating numbers to make things look better than they are.
So don't trust the adjusted numbers, look at the real numbers.
Exactly.
All right, so we've covered the non-insurance businesses, but let's shift gears to that Fifth Grove insurance.
Yeah.
This has always been a cornerstone of Berkshire's strategy.
Right.
So what makes insurance so important for them?
Well, that's where the power of float comes in.
Okay.
Think of it this way. Insurance companies collect premiums up front, but pay claims later.
Right.
This creates a pool of money they can invest while they wait, which is the float.
Okay, so they're basically using other people's money to make even more money.
It's a huge advantage.
But there are risks with that, right?
Absolutely.
Mm-hmm.
Buffett acknowledges the risks involved.
Right.
You think about those asbestos claims, the mega catastrophes, or even unforeseen events like a major cyber attack.
Right.
Any of those could lead to significant losses.
Yeah, that's scary stuff.
It is.
But Berkshire seems to have a knack for managing those risks. They have a pretty impressive underwriting track record.
They do. They've built a strong reputation for disciplined risk assessment and avoiding unnecessary risks.
Right.
And that $39 million in float back in 1970 has grown to over $122 billion in 2018.
Wow.
That's insane growth.
That is insane growth. So we've got float as one unconventional funding source.
Mm.
What other tricks does Buffett have up his sleeve?
Well, he also talks about deferred income taxes.
Okay.
These are taxes that Berkshire will eventually have to pay.
Right.
But in the meantime, they can invest those funds. It's like getting an interest-free loan from the government.
Clever.
Yeah.
And I remember him talking about his cautious approach to debt. He'd rather build slowly and steadily with retained earnings than risk it all with leverage.
Right. He's a firm believer in compounding, letting those profits snowball over time.
Right.
It's a strategy that's clearly worked well for Berkshire.
It has. Speaking of success stories, there's this fascinating section about Tony Nicely, the longtime CEO of Geico.
Oh, yeah?
He took the company from near collapse to becoming the second largest auto insurer in America.
Right.
What struck you about his story?
Well, Nicely's journey is a testament to long-term vision and operational excellence.
Yeah.
He joined Geico at 18,
Wow.
witnessed its near collapse, and then led its incredible turnaround.
Right.
I mean, Buffett estimates that Nicely's leadership added over $50 billion to Berkshire's intrinsic value.
That's amazing.
That's remarkable.
That's an amazing story. And it makes you wonder what lessons we can learn from him, right?
Yeah. What are the ingredients in his success?
Like, what are the key ingredients?
I think it's a combination of factors.
Yeah.
Long-term vision, operational excellence, and a strong company culture.
Right.
He embodied those values.
He lived it.
He lived it, yeah.
Now, let's dive into Buffett's investment philosophy, because this is where it gets really interesting.
Yeah, this is the fun part.
So he gives us a glimpse into his stock portfolio, but he doesn't just see them as ticker symbols, right?
Exactly. He sees them as pieces of outstanding businesses.
Right.
And he stresses the impressive returns these companies generate, highlighting their responsible use of debt.
Right.
And their ability to compound earnings over time.
And he contrasts those returns with what you can get in bonds in a low interest rate environment.
Right, those paltry yields.
Right. It's like, why would you even bother?
Yeah.
But here's the key. He rejects this idea of trying to time the market or predict its movements.
Market time and forget about it.
Yeah, he's not interested in that at all. Instead, he focuses on identifying undervalued companies with strong fundamentals.
Yeah, he's looking for those diamonds in the rough.
Yeah, those businesses that the market might be underestimating.
The hidden gems.
And he finds them. But here's the intriguing part. He acknowledges that there are unquestionably many stocks that will deliver far greater gains than ours.
What?
Wait, why would he say that?
I know. It's almost like he's downplaying their success.
Doesn't that seem counterintuitive?
It does.
After spending the entire letter, highlighting all of Berkshire's successes?
Right, but that's the beauty of his approach.
Yeah.
He's grounded. He's realistic. He knows he doesn't have a monopoly on good ideas.
So that leads into his discussion of the American tailwind. This powerful force he believes has driven both Berkshire's success and the overall growth of the U.S. economy.
This is fascinating.
It is. He illustrates this with a really captivating story about his first investment back in 1942 when he was just 11 years old.
11 years old.
Imagine putting $114 into the market and watching it grow for decades.
Yeah.
He calculates that if those $104 had been invested in a no-fee S&P 500 index fund, they would have ballooned to over $600,000 by 2019.
That's the power of compounding.
It's the power of long-term investing, and it's a testament to the growth of American businesses.
Yeah, American ingenuity.
Right.
Incredible.
And that's compared to if he had bought gold,
Yeah.
it would have only gone to $4,200.
A paltry sum.
What do you think this comparison tells us about investing in American businesses?
Well, it highlights the incredible wealth-creating potential of American companies.
Right.
And, Buffett emphasizes that this success has been achieved through both Republican and Democratic administrations.
Right. It's not about one party or the other.
Exactly. It's a bipartisan story of economic growth.
And he recounts, the numerous challenges the U.S. has weathered over the decades.
Yeah.
Inflation wars, recessions, you name it.
You name it.
Yet the American economy has consistently proven its resilience.
It bounces back.
What's the secret sauce?
Well, Buffett attributes this resilience to a simple yet profound factor: savings.
Savings.
Yeah, America's culture of saving and investing has been the engine of innovation, productivity gains,
Right.
and ultimately a higher standard of living.
So it's not just about spending, it's about putting money aside to fuel future growth.
Exactly, and this ties back to Berkshire's own success.
Okay.
He acknowledges that much of it has been a result of riding the American tailwind.
Right.
He's not claiming that Berkshire's achievements are solely due to their own brilliance.
Right. He realizes he's had a tailwind.
He recognizes the importance of the environment they've operated in.
Yeah.
And it's refreshing to see someone of his stature acknowledging the role of external factors in their success.
It really is. It speaks volumes about his humility.
Humility and understanding of the bigger picture.
Yeah.
He goes on to acknowledge that many other countries have promising futures
Right.
and expresses Berkshire's desire to invest globally. But he maintains that the American tailwind will continue to be a driving force behind Berkshire's growth.
Right. That's a pretty strong vote of confidence in the U.S. economy.
It underscores his faith in American ingenuity and the long-term prospects of the market.
Right now, let's talk about stock repurchases, another topic he delves into in this letter.
Yeah.
He's a big advocate of buybacks,
Yep.
but only under the right circumstances.
Only when it makes sense.
So he explains that repurchases can be a win-win for both departing and continuing shareholders.
Yeah.
If Berkshire can buy back shares at a price lower than their intrinsic value,
Right.
it benefits those who are selling and increases the value for those who hold on to their shares.
It's all about creating value for the owners of the business.
Exactly. But he's very clear that buybacks should be done strategically,
Yeah.
not just to manipulate the stock price.
Not to juice earnings per share.
Right. He emphasizes the importance of being price sensitive. Why is that so crucial?
Well, buying back overvalued shares would destroy value.
Right.
He wants to ensure that Berkshire is always getting a good deal,
Right.
not just throwing money around.
Not just burning cash.
Exactly. And he stresses transparency throughout the process.
Right.
He wants shareholders to have all the information they need to make informed decisions.
About whether to sell their shares back to the company.
Exactly.
Yeah.
It shows his commitment to treating shareholders as partners,
Right.
not just passive investors.
And this approach to buybacks stands in stark contrast to how many other companies use them.
Oh, yeah.
You often see companies using buybacks as a short-sighted way to boost earnings per share.
Yeah.
Or appease Wall Street analysts.
Or to enrich management.
Right. And Buffett's not playing that game.
No, he's focused on long-term value creation for all shareholders,
Right.
not short-term gains or stock market hype.
And this long-term perspective is a recurring theme throughout the letter.
Absolutely.
He talks about Berkshire's lack of monthly earnings reports, their aversion to company-wide budgets, and their focus on building a culture that values intrinsic worth over short-term metrics.
It's a breath of fresh air in today's obsession with quarterly earnings.
Right.
He's urging us to look beyond the noise and focus on what truly matters.
Building enduring businesses.
Yeah, building enduring businesses that generate wealth for decades.
And he ends the letter with that thought-provoking statement we discussed earlier. There are unquestionably many stocks that will deliver far greater gains than ours.
Yeah, I'm still stuck on that.
It's a statement that seems to contradict everything he's just told us about Berkshire's strength.
I know, it's baffling.
It is baffling, but that's where I think his wisdom shines through.
Okay.
He's not claiming to have all the answers.
Right.
He's encouraging you to think for yourself.
Yeah.
And explore the full spectrum of possibilities, not just blindly follow his lead.
So what's the takeaway for the listener?
I think it's don't be afraid to challenge conventional wisdom.
Right.
Think for yourself and find those opportunities that truly resonate with you.
Be an independent thinker.
Yeah, and we'll explore that further in the next part of our deep dive.
Looking forward to it. Yeah, it almost seems like a challenge, right? Like
Yeah.
he's saying, I've shown you what's worked for me, but don't be afraid to go find something even better.
Yeah.
It's really interesting.
He's encouraging you to be an active participant in your financial success.
Be an independent thinker.
He's not saying abandon Berkshire Hathaway, but rather to understand that there's a whole world of opportunities out there.
That's right.
Right. And maybe there are companies out there, perhaps smaller or less known, that have even greater potential.
Yeah, think about it. Berkshire's a massive company.
Hmm.
They need to find investments that are large enough to make a real impact on their portfolio.
Right.
You, on the other hand, have the flexibility to explore those niche opportunities,
Yeah.
those hidden gems that might be flying under the radar.
Yeah, and that's kind of exciting, right?
It is.
It's like there's a whole universe of companies out there waiting to be discovered.
Exactly. And it reinforces the idea that investing is a dynamic process, a constant search for value.
Right.
It's not about finding one perfect stock and sitting on it forever.
Right.
It's about continuous learning, adapting and evolving your strategy as the market changes.
And that's what keeps things interesting, right?
Absolutely.
The market is never stagnant. There are always new challenges and new opportunities to uncover.
That's what keeps investors like Buffett engaged even after all these years.
Right.
He's still learning, still growing, still finding that joy in the process
Right.
of investing and sharing his knowledge with others.
It reminds you that investing isn't just about making money.
Right.
It's about the journey, the intellectual stimulation, the satisfaction of building something meaningful.
You can be a force for good.
Right.
It can support innovation, create jobs, contribute to the prosperity of society as a whole.
So as we wrap up this deep dive into Buffett's 2018 letter, what would you say are the key takeaways for our listener?
Well, I think first and foremost, don't be afraid to challenge conventional wisdom.
Okay.
Think for yourself.
Yeah.
Do your own research.
Yeah.
And find those opportunities that truly resonate with you.
Right.
Remember, investing is a marathon, not a sprint.
Right.
Be patient, focus on the long term, and never stop learning.
And if you do that, you'll be well on your way to achieving your own financial goals.
Absolutely.
And maybe even leaving your own mark on the world.
That's right.
This deep dive has given us a glimpse into the mind of Warren Buffett, a true icon of investing.
He's the best.
We hope it sparked your curiosity and giving you some food for thought.
We encourage you to explore the full shareholder letter.
Yeah.
Dig deeper into Berkshire Hathaway's history and, discover what resonates with you after all the best investment you can make is in your own knowledge.
Happy investing.
Yeah, it's almost a challenge,
It is.
Like he's saying, look, I've shown you what's worked for me.
Right.
Don't be afraid to go find something even better.
Yeah, he's not saying that Berkshire Hathaway is bad.
Right.
He's just saying there might be something out there that's even better.
He's reminding us that true value isn't always reflected in a stock price.
Right.
It's about understanding the underlying business, its potential for growth, its ability to generate cash flow.
And maybe there are companies out there, perhaps smaller or less known, that have even greater potential than what Berkshire is holding.
Right. And think about it. Berkshire's a massive company.
Yeah.
They need to find investments that are large enough to make a real impact on their portfolio.
Right.
You, on the other hand, have the flexibility to explore those niche opportunities,
Yeah.
those hidden gems that might be flying under the radar.
Right. You can be much more nimble.
Exactly.
It's exciting to think about the possibilities.
It is.
There's a whole universe of companies out there waiting to be discovered.
And it reinforces the idea that investing is a dynamic process,
Right.
a constant search for value.
Yeah. It's not like you just buy one stock and forget about it.
Exactly.
You gotta keep looking.
You're always learning.
Right.
You're adapting and evolving your strategy as the market changes.
And that's what keeps things interesting. The market is never stagnant. There are always new challenges and new opportunities to uncover.
It's a puzzle.
It is. And, that's what keeps investors like Buffett engaged even after all these years.
Right. He's still going.
He's still going.
He's still learning, still growing, still finding that joy in the process of investing and sharing his knowledge with others.
And it kind of reminds you that investing isn't just about making money.
Yeah.
It's about the journey, the intellectual stimulation, the satisfaction of building something meaningful.
And leaving a legacy.
Right. And, it can support innovation, create jobs, contribute to the prosperity of society as a whole.
Right.
So as we wrap up this deep dive into Buffett's 2018 letter, what would you say are the key takeaways for our listeners?
Well, I think, after going through all this, the main things to remember are, one, don't be afraid to challenge conventional wisdom.
Okay.
Think for yourself.
Yeah.
Do your own research.
Right.
Find those opportunities that truly resonate with you.
Right.
To remember, investing is a marathon, not a sprint. Be patient, focus on the long term, and never stop learning.
And if you do all that, you'll be well on your way to achieving your own financial goals.
You got it.
And maybe even leaving your own mark on the world.
That's the goal.
This deep dive has given us a glimpse into the mind of Warren Buffett, a true icon of investing.
The Oracle of Omaha.
We hope it sparked your curiosity and given you some food for thought.
There's a lot to unpack in these letters.
There is.
They're a treasure trove of wisdom.
Absolutely. And we encourage you to explore the full shareholder letter, dig deeper into Berkshire Hathaway's history, and discover what resonates with you.
Yeah, there's so much to learn.
There is. And after all, the best investment you can make is in your own knowledge.
Absolutely.
Thanks for joining us.
This was fun.
It was a good one.
Always a pleasure.
We'll see you next time.
See you later.